This is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Matthew Piepenburg from Von Greyerz. Matthew, thank you so much for joining us today.
Oh, it's great to be back. Thanks again for having me. It's always a pleasure.
Well, it's great to have you today, especially today when we're seeing precious metals rise significantly. Silver's kind of almost retesting all-time highs here, above $53, racing towards $54. Just, I guess, a general overview of the markets we've been seeing the last couple of days.
Yeah, again, we've been talking about gold for years, and certainly in the last few months when you see all-time highs, you know, how many we've had this year, over 45, and then if there's a little bit of a pullback in the precious metals prices, silver or gold, there's a big concern. Have we reached peak gold in 2025? And then when gold gets back up again, those headlines dissipate. And I understand that, you know, headline concern. I think for most of your viewers at this point who have a high conviction in precious metals, price movements in a bull market like this didn't dissuade them from their longer-term play and longer-term view on why you need to own precious metals. And I want to answer the question fairly without just, again, as always, suggesting just my conviction or bias. I've said many times, this is not an ordinary bull market. This is not an ordinary asset. This is a monetary metal, a precious metal. It's not even an ordinary commodity. It's not even an ordinary metal. And if you understand the context and why you originally bought gold and silver, which I hope was not just for immediate price appreciation to get rich, but because you understood and understand a systemic problem in the financial and the monetary system, not only in the US, but globally. And we'll talk about that. And I certainly would like to talk about silver too more, because for a lot of investors, that's a more affordable way to understand this. But you know, when Egon von Greyerz started our company decades ago, it was with a long-term vision of many things, including banking risk and political risk and currency risk. But, you know, there was a reason he was buying gold at those levels, and there was a reason he was holding it outside of the banking system, and there was a reason he would rather save in gold and silver than in dollars or euros or francs, or at the time, you know, whatever, it was even pre-euro. It was simply because of an understanding of history and math and markets that the banks were risky, and we'll talk about banking risk, that holding your precious metals and your store of value, which is a better store of value than any paper currency outside of that banking system, made sense in 1995 and 2003, and it makes sense in 2025. If you understand these core issues, whether you bought gold at 1,600 or 2,800, or whether you buy gold when it gets to 5,200, you'll still understand why you bought it. And I think the simple answer is if you can't know the solution if you don't know the problem. And decades ago, Egon and many others, and myself later, understood the problem. And the problem, of course, as we've discussed in so many iterations, and we can bring out all the data, it's not just sensational, is we have a massive, unsustainable global debt crisis. It has been percolating pre and post-COVID. It's been percolating pre and post-2008. When you have a debt crisis, wherever your zip code is, whatever your central bank is, whether it's the ECB, the Bank of England, whether it's the Fed, central banks from Australia to DC will monetize that unsustainable debt with money created literally ex nihilo, out of nowhere, expanding credit, expanding the money supply, and debasing the currency. That's a very simplistic understanding of the problem, that currency will be debased over the long term. The inherent purchasing power of your paper currency, whatever currency that is, certainly the home of the world reserve currency is important. That whatever that currency is, it will lose its inherent purchasing power over time, as it has done, again, from ancient Rome to Philip II in Portugal in the 1500s, to the British Empire, the Dutch Empire, the US Empire. Again, doesn't mean the end of all of these empires, emphatically, Rome is still there, DC is still there, London is still there, but the purchasing power of those currencies and of those hegemonies inevitably debases itself because of the addiction to easy money and the addiction to debt to stay in power, whatever power that is, whether it's democracy or not. You need to spend. When you no longer have a chaperone to that money or that currency, whether it's a denarius or a dollar, you whittle away at the precious metal aspect. You decouple it from the gold standard, which is literally in Article 1 of our Constitution, and then you can go into greater debt and that you can debase your currency. So again, simplistic historical lesson, but if you understand precious metals as a store of value, not a NVIDIA stock, not Anthropic, not a tech trade, not Tesla, whatever other asset that has made you rich or poor in the last 20 years, depending on your entries and exits, if you understand gold and silver as a better store of value to preserve your wealth against debased paper money, if gold goes down 10% in a 2-week period in these recent all-time highs, that doesn't bother you at all, because if you understand the problem, you have the conviction that this store of value, this silver or this gold that I own, is only going to go up further in a secular manner, not a straight line. It's only going to go up further in a secular manner because there is no immediate solution to the problem of debt. Again, we've talked about debt in 80 different ways, but it's nothing new throughout history. Sometimes history, again, is harder to see when you're in it. But no, as always with me, it's a long answer to a short question, but no, it is not a surprise to see gold going back up again. It will not be a surprise when it passes 4,800 or 5,000 or 6,000, only because this is not a bull market in precious metals. It is a bear market in paper money. You either believe that or you don't. You either accept that or you don't. We can spend a lot of time, and we have spent a lot of hours over the years talking about this. That's a personal choice. You should take your own informed judgment on that, but I think the evidence, which we can get into too, is fairly obvious that the world is catching on after decades of overextending debt levels to such a degree. It could be done for a while, but it's gone to that tipping point. It's like boiling water. It gets very hot for many, many minutes, and then at some point, it starts to boil. What we've seen since November of 24 and all of 25 is that boiling point has been reached. The water is now boiling. The awareness of the weakness of paper money in general and the world reserve currency in particular is now obvious, from the petrodollar to de-dollarization to the BIS to Morgan Stanley. The world is seeing this now, and I think retail investors, sadly, are the last to figure this out, because for decades they've been told by their private wealth managers or their online advisors or the RIA industrial complex that gold was just some pawn shop asset or precious metals were passé analog pet rocks, despite the fact that gold has outperformed in total return the S&P for a quarter of a century. Now that once intentionally misunderstood and ignored asset is making the headlines. Retail investors are starting to catch on that there's more to life than tech stocks or the S&P. And they're starting to ask why gold is rising. And if they take the time to really look, without, you don't have to go into thousands of history books, but if they take the time to get an objective opinion on what is currency debasement in the backdrop of a debt setting like this, it really isn't that hard to see. It doesn't mean that you can't look at Bitcoin or cryptos as other anti-fiat solutions. That's another rabbit hole. I'm here to talk about precious metals because that's what I've chosen. That's my bias. That's our conviction. We definitely want to hold this asset, as we've warned for decades, as Egon has seen for decades, outside of the banking system, which has many risks, and to hold it privately, the best gold you can get, outside of that system, and to store your wealth in that, and to save, like central banks in the East are now doing, to save in a precious metal, which holds its value, and then spend in fiat as you need it. That explains why central banks now hold more gold than they do U.S. Treasuries. That sacred cow, that tier one asset of decades past, has now been replaced slowly but surely by physical gold. And we can look at the COMEX flows, and we can look at some of the wonky math, and we can look at the repo markets and the banking risks. But this isn't even a gold bug argument anymore, Elijah. This is known everywhere. And I think it's sad that retail investors are still catching on. They're still less than 1% of their allocations to gold. They're still highly in the 60-40 or some version of the 80-20 stock bond portfolio. And they're trying to figure this out. And platforms like yours and opinions like mine are certainly worth looking at. They don't have to take it at face value on the first watch, so to speak. But I think most of your clients, certainly our listeners, they've heard this before. They know this. They have the conviction. So again, the price moves month to month, week to week, day to day, aren't really their main concern. And I'm not exaggerating. My partners and I and Egon, we don't really talk about the daily gold and silver price. We haven't talked about it for years because we just know with confidence that it will continue to move in a direction, again, never in a straight line, only because the situation in the global system, the global debt levels is so empirically obvious now. And that whatever reset to come, whatever revaluation to come, whatever political mechanizations to come, from stablecoin to Doge to USA, whatever happens, we do know this: East and West, BRICS and the IMF, West and East, are looking more of gold, looking more at gold in particular, as really the new reserve strategic asset. That is a geopolitical, historical move. It is not a market move with a chart that you just need Bollinger Bands to follow to buy and sell. Because if you really understand gold, you'll hold it as a store of value, and it will be worth more in 10 years than a $10 bill in your pocket, regardless of where the price goes. And again, sorry, hugely long answer to your very simple question, but that's how I see it.
And you mentioned the issues in the banking system, the huge shift globally away from the dollar and into gold. I did want to highlight what is happening in the banking system right now, because you just wrote about this, and it's something that is really overlooked in the mainstream media for the most part, the reverse repo market and what is happening there. So what is happening in there, and how is it another tailwind for gold?
Well, again, it's another one of those little areas of the market which many in your audience understandably don't follow. It's the spread between the repo market and the Fed funds rate. Again, that sounds really wonky. And I want to make it simpler because it's meant to be complex, it's meant to be overlooked, and it's really meant to be misunderstood. But in simplest terms, it has a huge impact on liquidity in the markets. It has a huge impact on central bank solutions and more liquidity to come, which means it has a huge impact on the direction of gold and silver going forward. But again, and not to get too complex, the repo markets are places where basically commercial banks go to borrow from each other in overnight loans. And they post collateral for that overnight loan. And then the next day they pay back that loan at a rate called the repo rate, which is a little bit higher for the overnight lending, for the overnight borrowing. So the banks help each other out with liquidity. It can be large or small amounts. It's an overnight liquidity form. And it's very important to keeping the grease of the engine that is the commercial banking system running smoothly. And 99% of the time it runs very smoothly. Like 99% of the time, hopefully a new car runs smoothly. But if you don't keep oil in that engine, no matter how good the car is, it will start to smoke and chuckle and choke. And eventually, if you don't put oil in at all, it'll blow up the engine. And if you think of the repo markets in the commercial banking system, that overnight loan, that overnight liquidity helps them keep the wheels of their lending and their operations greased. So those repo markets are important. And the rate for borrowing overnight is important. When that rate starts to spike, that means there's a low oil warning light. As I said in the article, there's a low oil warning light in the engine. So you need to put more oil in quickly. If you wait too long, it really blows up the engine. And what we've seen recently is that the SOFR rate, or the overnight repo rate, has started to go, the spread between that and the Fed's fund rate is getting higher. That means that there's a liquidity problem. The Fed is mandated to make sure that liquidity is there. It also means that these banks, among the too big to fail banks, are not trusting each other's collateral in the way they usually do 90% of the time or 99% of the time. Of course, the biggest implosion in the repo markets was in September of 2019 when the rates went up to 10% in a day. That was a major shock to the system. It cost hundreds of billions in immediate liquidity. And recently, a bunch of these primary dealers, these big banks, met at the New York Fed because there's a problem in the repo market. They're concerned that the rates have risen, these repo rates have risen, despite the fact that the Fed had just put in $125 billion prior to this. Again, without getting into the repo markets and then the emergency liquidity from the reverse repo markets, it's very simply saying that there's less and less liquidity in the banking system. There's less and less trust among the banks. There's less and less oil in the engine. That engine is so critical to the U.S. banking system, which is so critical to the global banking system, which is so critical to U.S. Treasury purchases, and so critical to derivatives trades, which are collateralized by U.S. Treasuries like the repo markets. I'm grossly simplifying, but you don't need to get into the complex to basically understand when you see repo rates surpassing the Fed funds rate, excuse me, that's a sign that A, banks are losing trust, and B, there's a liquidity problem. And what that has to do with gold, of course, is to go to the reverse repo facility to bail out the repo markets, to bail out the banks that use those markets, is really just QE by another name. And so QE, of course, is printing money out of nowhere to provide liquidity. That's expansion of credit. That is indirectly an expansion of the money supply. Inflation is the measure of the expansion of the money supply. And when inflation, however it's misreported by the CPI scale, increases because of currency debasement through expansion of the money supply, that's usually and always a tailwind for an anti-fiat instrument like precious metals in general and gold and silver in particular. So these little tiny corners of the Wall Street world, which are the reverse repo markets and the repo market and the overnight markets, are again not on the water cooler conversations of your average conversation at work. It's not what you talk to your wife with a coffee at breakfast. It's usually not the first conversation at a football game or a golf outing, but it's there. It's ticking in plain sight, kind of hiding in plain sight. It's very much misunderstood, but the ripple effects of spiking repo rates can be very, very dangerous. And again, 2019 was an extreme example. We're not at those rates now, but the fact that we're there is no shock. We've had Powell trying to tighten the balance sheet all year, keeping rates low, but clearly, as of December, there's clearly a sign from the repo markets. It's on that dashboard of your car. It's a symptom that liquidity is tightening. When credit tightens in a world that is supported by easy credit or debt, when you start to see warning signs on the dashboard like that, this far into a debt cycle where we're literally at 38 trillion in public debt, where we're projected to have 50 billion. This Congressional Budget Office says 50 billion by 2033. When you see that kind of debt and that sustains us, and then credit markets tightening in those debt markets or lending tightening, and we see it in the subprime markets, we see it in private equity and private credit pools, we're seeing little symptoms all over the place of credit tightening in a world so enamored and so survivable by debt. To see these type of warning lights, whether it's at the repo markets, and we can talk about the private equity markets, the private credit markets, this is not a good sign in an already world full of bad signs from Main Street to Wall Street. So again, these simple little repo rates are a screaming indication that credit is tightening, liquidity is becoming drier. Boy, those are shark fins in a market sustained by debt like this. That's the simple answer. And of course, the solution will be mouse click money, fire hose money, helicopter money, whatever you want to call it, bazooka money. That's typically a tailwind for precious metals, which already have so many tailwinds on their backs as it is. It's just one more bull case for gold. Again, I'm a gold guy, but I'm not doing data mining. This is a data analysis. In my mind, it's just another warning sign.
It is interesting how you talk about how kind of the engine of the banks, they need more oil, right? They need more liquidity, and that's really drying up because of what's happening in the repo market. But I guess going forward here, this seems like it could be a major issue for the banking system. I know back in 2023, a lot of people were scared about having too much money in the bank when Silicon Valley Bank collapsed, First Republic, and a few others went under. Your take on kind of the stability of the banking system, and could this there's one aspect that we talk about all the time, that there's inflation, and if you're holding money in the bank or if you're holding dollars, that's being devalued. But there's also the aspect of like, am I actually going to even be able to get the dollars that are in the bank? Your take on that?
Yeah, that's a really important question. I mean, I've written a lot about, we can talk about derivatives. It's a whole other silo of extraordinary banking risk. But to your point, when liquidity is drying up, when repo rates are spiking, when banks are starting to smoke in the engine because the grease is drying and liquidity is drying, that is reminiscent of Signature Valley Bank and these other smaller banks, you could say, still with massive balance sheets, but those were 3 of the 4 largest banking fails in our history, and that was just a couple of years ago. So the question you're saying is this a sign that these banks could fail? Now, the banks that use the overnight repo markets are your classic too big to fail banks, the JP Morgans, the B of A's, the Goldman Sachs. By the way, when they borrow from each other, that's kind of a stigma. They don't like to admit that they're borrowing from each other overnight. They don't even report that publicly. It takes 2 years. There's anonymous trading going on in the reverse repo, in the repo markets. It's already a sign that the very fact that they're there means they're a little tight and they need a little cash. And then the fact that they're there and the rates are going high suggests there's some cracks in the armor in those banks. Now, during the banking crisis that capped it out in Signature Valley Bank, et cetera, in 2023, that was a major problem. Of course, the reason they failed wasn't because they had no cash. The reason they failed is their balance sheets were full of U.S. Treasuries. And because Powell was raising rates, as rates went up, the bond prices, which were the collateral of those banks, went down. So the banking crisis of 23 was really a bond crisis, a credit crisis, a rate crisis. And your question is very apt. Now, FTC insured certain accounts to $250,000. Of course, there was emergency liquidity. It costs a lot of money. There was a bailout of the depositors in those smaller banks. And your question is, could that happen again? Is this another symptom outside of the whole derivatives market, which is another major banking risk? And the short answer is for smaller banks, it could be, because there's only so much the government can do to bail out failed banks. But again, as we saw in 2023, they'll do it because they don't want the contagion effect of depositors losing faith in the banking system, even with the smaller banks in particular. So they bailed them out. And of course, indirectly, the taxpayer ends up paying for that. And the dollar gets debased to pay for that because the mouse click money used to save those systems isn't come tax receipts or GDP. So indirectly, we're all paying for those failures, but the depositors were saved. So the larger question is, will banks always be bailed out? There's 2 ways to answer that. The smaller banks arguably could be allowed to fail. As we saw from 2008, the bigger banks are literally too big to fail. They're a matter of national security. I remember when Signature Valley Bank was failing, or when they were having that crisis in 23, I got a lot of phone calls from wealthier people I knew in the US saying, Matt, I'm at a West Coast bank. Should I just go to JP Morgan or Goldman Sachs because they're too big to fail? Literally, that was the question. And without having a crystal ball, and cynically, I still think that almost anything is too big to fail, but smaller banks can be allowed to fail. If you're in a smaller savings and loan bank, we've seen how those can be pinched in the past, in the 80s. Could there arguably be a liquidity crisis? Nothing's impossible. Again, when we started von Greyerz 3 decades ago, one of our biggest concerns was banking risk. Don't hold your gold in these banks. The flip side to that case is, we saw in 2008, we've certainly seen in other areas where the government and the Fed and the policies seem to indicate that certain banks, certainly the banks using the repo markets, are literally too big to fail. Bear Stearns, Lehman Brothers, they weren't the same type of depositor banks that Morgan Stanley or B of A or Citigroup is. And I think the fear that if they didn't bail out those banks, the ripple effects on Main Street would be too great. So the good news is they'd probably be bailed out. The bad news is that's really good for gold. It's very bad for the dollar because the cost of those bailouts is in the trillions. I mean, the great financial crisis, which began because Jimmy Kane at Bear Stearns had a $600 billion balance sheet of assets and liabilities. What he didn't say is he had $35 trillion in uber-levered derivatives on subprime mortgages. So that bank failed, and that spread to other banks who were counterparties. That spread to AIG, which is insuring the CDS. In other words, it was a domino effect, and it cost the world about $27 trillion to bail out that crisis. And today, the derivatives market is 10 times the size it was in 2008. We learned nothing from 2008. Even if 5 or 10% of those banks failed, the cost to bail them out would be more than '08. To bail them out would require bazooka money, which would be further debasement of the greenback in your wallet or the dollar in your wallet. So that is an invisible theft, even if the banks are bailed out, even if your checking and savings accounts were saved, which is no guarantee, but I think they probably would be. But even if they were, the net result is, be careful what you ask for. You get the bailout, but the inherent purchasing power of your ice cube dollar bill is continually melting, because the only way to pay for that is with money the government doesn't otherwise have unless they manufacture that money out of nothing. And that is the definition of credit expansion. That is the definition of money supply expansion. That is the definition of inflation, the invisible tax, the currency debasement, etc. They now call it the debasement rate. It's so obvious now. But yeah, banks could be at risk because of these signs from the repo market. They can be at risk because the derivatives market that took down the great banks of 2008 is 10 times what it was in 2008 today. And they learned nothing from that lesson, and Dodd-Frank did nothing to fix it. Yes, there's banking risk, but even if they are saved, there is no happy solution or happy ending, because they're only saved by debasing the currency. If they're not saved, well, woe be it to you who have anything more than $250,000 in an FDIC insured bank, because the rest technically is on you. In other words, good luck. And so, in this climate, with this level of debt at the government level, at this level of debt and risk at the banking level, it's just one more thing for people to have to deal with and think about. The short answer is, I don't think the major banks would fail. I think they'd be, as a matter of national security, bailed out. But I think the cost of that bailout would just be one more insult to the dollar, one of many insults to the dollar, and one more tailwind for gold and silver.
Yeah, it reminds me of, I think, back during COVID, right, when people got the stimulus checks, but then, oh, wait, the next year, inflation is rising. And I think it was estimated that each American, had to pay, something like $5,000 more just because prices were higher. So they get, $2,400 in checks the year before, but then they have to pay more the next year, which is just, it's crazy how inflation is really that hidden tax on the public. And so many people are unaware of it or don't think of it that way.
Well, inflation is another term that's just boring, like repo markets and repo, spreads with the Fed funds rate. It's really meant to be boring and kind of innocuous and something complex. The government will fix it. Don't worry. Inflation, well, I hear that the scale is kind of bogus, but it's around 3%, 2.5. It's okay. Well, no, it's not okay. Again, we could spend an hour on this. You can take my word for it. You can look up John Williams. You can go to Shadow Stats. You can look at other very, very smart guys like Neil Eberstadt, or there's a couple other folks that really do track inflation using the same scale that we used during the Volcker era, which is the only way to be fair. You've got to take the same IQ test to measure intelligence. You can't have two different tests. You can't have two different CPI scales to measure inflation. If we're comparing ourselves to where we were in, say, 1980, it has to be the same scale. That scale has been adjusted 22 times since 1980. But if we use a real scale, then actual inflation is actually 10 or 11%, not the reported inflation, which, again, I think everyone on Wall Street knows is bogus. They're never right, but they're always correct because it's the official number. But let's just say it's 10%. Let's say it's 7%. If you're losing 7% per year on the purchasing power through the invisible tax of misreported inflation, you're being robbed. I mean, it's a robbery. And so inflation really does matter. How it is measured really does matter. How it is reported really does matter. I personally think, like many others, the inflation scale is an open lie. Now, you don't have to take my word for it. Do some research. Look up some of the alternative inflation scales. There's some who say it's much lower. I've looked at them. They're laughable, what they're doing, how they're making it work. But if we use the same scale that we measured inflation with during the highest inflation period under Volcker, we're very close to 11% right now. Now, of course, if I were a government agent or a leader, or I was at the BLS or the Fed or the White House, I would not want that news to be known. And as Jean-Claude Juncker, the former head of the European Commission, said, when the news is really bad, we just lie. That sounds sensational. But again, I think the evidence is fairly objective that the CPI scale, as I've said so many times, is as bogus as a 42nd Street Rolex. It's just not real. And yet, it is so important to understand. And whether, even if you think it's 3%, let's be extremely conservative. Well, that's a compounding loss of your money every year. If you go in the middle and say it's 5%, it doesn't take many years for you to lose more and more purchasing power, which is why you don't want to save in in a paper currency, because whether gold or silver goes up in a straight line or not is irrelevant. It holds its value objectively more than any paper currency. So while you're saving at that bank or wherever you keep your money, and you're keeping that Folgers can because you're so proud of the savings, what the government is doing is it's stealing your savings. It's stealing the purchasing power. It is more than an invisible tax. It's literally theft. And whether you're making billions or millions or tens of dollars a week, that's insulting to whatever you have. And again, that explains why the world in the central banks and even the counterparties in the commercial banking system want their physical gold now more than they want US dollars and US treasuries. That isn't even a gold bug case anymore, Elijah. I mean, again, look at Jeffrey Gundlach, Double Line. He's the bond king. He's very aware of U.S. treasuries and U.S. currencies and other spreads. He recommends a 25% allocation to gold with a straight face. Jamie Dimon, head of JP Morgan, clearly has been kind of ignoring gold in the headlines for decades. He says gold can easily go to 10,000. Morgan Stanley, Goldman Sachs, but Morgan Stanley famously, Mike Wilson, Mike Hartnett, they're all saying 60-40, 60-20-20. You need 20% in gold. So it's not even the gold bugs anymore, as I've said many times, that are pounding their fist and screaming about this pet rock, this barbarous relic, buy my gold, come to my service. It's not us anymore that are saying this, although I think I'm very proud of seeing this years in advance. Now the mainstream financial markets, the mainstream banks are having to allocate to gold, I think largely because their clients are demanding it now. And largely because they can't ignore what they've been able to do for 20 years, gold's obvious role. Again, if you know the problem, you need to see the solution more clearly. Even the large too big to fail banks like Goldman Sachs, like Morgan Stanley, like JP Morgan, and even the equities guys like Jeremy Grantham, like Ray Dalio have a lot of gold. And even the bond guys have a lot of gold. And again, we have clients from over 90 countries. I will never say who they are. I'm just saying you'd be surprised who they are because they're not, they come from banks and funds that talk about dollars all the time, but they're personally holding gold. So I see it anecdotally, I see it objectively in the markets, I see it at the banks, I see it at the BIS. It's almost easy now to be a gold bug. And there are so many Johnny-come-latelys, as the American expression, who coming to gold now. There's so many platforms that are talking about gold now, where you and your father and your partners have been there for years. Sheckman has been there for years. Egon has been there for years. For a lot of the times, we were the kooky guys, even though we had Wall Street backgrounds and relatively good credentials. People thought we were just selling our book, and we've been very sincere. I think I'm very proud of it, and very honest about our strong views. And what's interesting now is our strong views are just part of the mainstream now. It's almost too easy to talk about gold. And I think it's an interesting time after all these years looking at precious metals, having come from risk assets myself, having come from a banking background, having been on the buy side as a family office executive, looking at hedge funds and spreads and private equity and private credit. I've written for years about the risks in private credit, in subprime, in AI, and now it's all just becoming mainstream. It makes me feel kind of good, but I'm not smug. There's all kinds of other risks, but I don't have a lot of fear about precious metals, and I really don't look at the price. But yeah, there's just so many signals, including in the banking system, that folks should at least consider gold and silver a lot more seriously.
Well, Matthew, we really appreciate your time today. As always, if people are interested in learning more, they can go to vongreyerz.gold to find your articles there. Can you tell us a bit about this?
Yeah, no, it's a fantastic educational website. Like I said, we have partners like Egon. I've got, advisors like Ronnie Sturfel, Grant Williams, Alistair McLeod. So a lot of our interviews are there. All of our interviews are there. I've been, a partner who's out of the banking system, who understood gold very well, understands it very well, worked at Morgan Stanley. He's doing some great interviews with guests like Alistair and Ronnie and Egon and myself. All our articles that go years back can be found there. It's more than just a place to become a client for Von Greyerz. Our minimums are very high. We serve a very high net worth clientele. We have the best vault in the world. We're in jurisdiction in Switzerland. We have direct access to the refiners for the best gold. So it doesn't mean everyone can be a client, but anyone can go there to understand why gold matters, why they should consider gold, different ways to own gold. It's a free education. And yes, we are absolutely selling our book. Yes, we are absolutely selling our conviction. But I got to say, it's not just to become a client. It's a good place to get an education. And as I always say, don't just take what me or Egon or Ronnie Sturfula or Alistair McLeod say. You can look at alternative views and get informed in your own way. But I think the evidence is becoming more and more overwhelming that gold does matter. And as the book that Egon and I wrote is literally called Gold Matters, I think that's just becoming more obvious now. And prices are going to get higher. Premiums are going to get higher, whether you're buying coins or bars. There will never be a time where you can't find gold or silver, but there will be a time when it's going to get much more expensive. And I think it's really important for all investors of all financial levels to give precious metals a more serious look. It's becoming pretty undeniable now.
Once again, Matthew, thank you so much for your time today. And do you have a good Thanksgiving there? And I'm not sure, do you guys still celebrate it there?
I mean, we're half American, half French in the house. When I'm in the U.S., I want to celebrate it. It doesn't feel genuine to be doing that in Europe. I don't know, for me. But I'm sure we'll have some phone calls to my folks in the States. But well, it's just another day as usual here in Europe for me tomorrow. But I wish you the best, Elijah, with your family, of course.
And to all our viewers, happy Thanksgiving out there. Thank you so much, Matthew. You have a good day and God bless.
God bless, Elijah.